Hello, everyone. This is Jillian Verdun from JMV Financial Services, your profit strategist, bringing tips and tricks to improve your financial situation for the new year. Thank you again for joining us and tuning in. We're going to talk about 8 ways to save money when you make money selling your home. I get this question asked to me a lot from clients when they sell their personal residence. So, most people believe they have to pay the taxes on the gains from the sale of their home. But did you know there's a good chance you may not have to? Here are 8 tax facts to keep in mind if you're selling your home this year. Number 1, exclusion of gain. Gain means the amount you received over and above what you originally paid for your home. In order to be able to exclude on your taxes part or all of the gain from the sale, you must have owned and used the home as your main resident for at least 2 out of 5 years before the sale of it. Number 2, exceptions. Of course, there's always exceptions. As with most anything, there are exceptions to the rule when it comes to the gain from the sale of your home. For example, people with disabilities, as well as certain members of the military, are offered exceptions on the taxation of their gain. Be sure to contact me so I can help you get a better idea of some of the other exceptions and savings you may be entitled to receive. Number 3, exclusion limit. The most gain you can exclude from your taxes if you file as a single individual is $250,000. The limit is $500,000 for joint returns. The net investment income tax will not apply to the excluded gain. Number 4, not all sales have to be reported. If the gain is not taxable, you may not need to report the sale to the IRS on your tax return. What must be reported, however, is if you can't exclude part or all of the gain, or if you choose not to claim the exclusion. You must also report the sale if you get a Form 1099 S as in Sam. It's called Proceeds from Real Estate Transactions. If you do report the sale, be sure to review the net investment income tax questions and answer on irs.gov or contact the office for more guidance. Number 5, exclusion frequency limit. You may only exclude the gain from the sale of a main residence only once every 2 years. There are some exceptions to this rule that may apply as well. Number 6, only the main home is eligible. If you own more than one home, you may only exclude the gain on the sale of your main residence. That's the home you live in most of the time if considered your main home for tax purposes. Number 7, first-time home buyer's credit. Several people forget about this credit because if you received the $7,500, you're currently paying $500 back every year. It's claimed on your tax return. So if you claim the first-time home buyer credit when you bought your main home, there will be special rules that apply to the sale. These rules can be tricky, so be sure to reach out to a member of our team for specifications. Number 8, a loss instead of a gain. If you sell your main home at a loss, you can't deduct the loss on your tax return. Bonus tip, just in case you forget, after you move into your new home, be sure to update your address with the IRS by filing Form 8822, Change of Address. The address to mail the update to is found on page 2 of the form's instructions. Also, if you purchased health insurance to the health insurance marketplace, you should notify the marketplace when you move out of their area of coverage. Once you can notify them of that information, you'll make sure you get all of your tax documents sent to you in the mail in a timely fashion. We would like to thank you for listening today, and please follow us on your favorite podcast. Bye.